In 1985, the Australian government declared war on property investors. They introduced capital gains tax. 6 months later, they abolished negative gearing entirely. The commentators said property prices would finally fall. Instead, Sydney rose 36% in 2 years, Melbourne 19%, Perth 18%, Hobart 14%. Dozens of regional markets boomed. The government quietly reversed the whole thing in 1987 and hoped you'd forget. 41 years later, Canberra is running the sequel. And if you understand what actually happened last time, not the politics, the mechanics, you'll see why the next leg of growth is already being poured into the slab of every new house in this country. If we haven't met, my name's Sean and I run PropSpotter. We do 3 things in this order. We research 30 plus institutional data sources, every suburb, every segment before a single property is shortlisted. We source proprietary listing alerts across our markets, fixed fee, no commissions, no kickbacks. We're paid by you and only you. And last of all, we coach. Every client gets support on WhatsApp throughout their journey because buying the asset is only one part of the strategy, not the end of it. We keep our client book deliberately small, and you apply to work with us, you don't inquire. More on that at the end. Right now, let's talk about 1985. Here's the history, and I'm drawing on an article published this month by Simon Presley, Head of Research at Propertyology, REIA Hall of Fame, and one of the few analysts in this country whose forecasting record actually deserves the word. The link to the full article is in the description. July 1985, the Hawke-Keating government does 2 things at once. It introduces capital gains tax on investment assets, and it scraps negative gearing, meaning property investors could no longer offset rental losses against their other income, something every multi-income taxpayer had been able to do since the 1880s. The typical Australian house at that moment, on Presley's figures, was worth $75,000. 2 years and 2 months later, September 1987, negative gearing was reinstated. Why, you ask? Because rents had surged in the tightest markets, Sydney vacancy collapsed below 1%, and prices, the thing the policy was supposed to restrain, kept climbing anyway. And here's the 41-year scoreboard since that experiment. That $75,000 house is now, on Presley's numbers, $1.2 million. Population, 15.8 million then, 28 million now. And home ownership? It stayed between 67 and 72% the entire time, through every tax change, every government, and every panic. 31 prime ministers, ladies and gentlemen, since Federation have governed with negative gearing in place. The exception lasted 26 months, and prices rose straight through it. As Presley puts it, tax policies and property markets are very separate things. Now apply one simple test to the claim that negative gearing and the CGT discount are what drive Australian house prices. If that were true, if tax policies set prices, then every market in the country would move together. Same tax code in every postcode, same incentives for every investor. So look at the last 10 years using the figures Presley published. Sydney apartments up 20%. Houses in Dubbo, 400 kilometres inland, up 90%. Hobart houses up 110%. Perth, 60%. Bendigo, 90%. Hervey Bay and Maryborough on Queensland's Fraser Coast, 135%. Melbourne, over that same decade for houses, roughly 50%. And Darwin apartments, down. Same negative gearing rules, same capital gains tax, every single postcode. One asset went backwards 15%, while another, under identical tax settings, more than doubled. Tax policy cannot explain that spread. Only one thing can: the local balance of supply and demand. How many dwellings exist? How many are being added? And how many people with jobs and incomes need them? That is the entire game. It's why our research process screens every suburb for vacancy below 1.5% and a building approvals pipeline that isn't about to flood the market. The tax code is national, but your returns, ladies and gentlemen, are local. So, if tax doesn't set prices, what does? Let's start with the floor under every house price in Australia: the cost of replacing it. Cotality's Cordell Construction Cost Index, the industry benchmark, has national residential building costs sitting roughly 35 to 47% above where they were before the pandemic, depending on the segment. The ABS reports new home building costs rose 3.7% in the year to February, the fastest annual pace since late 2024. And that was measured before the latest fuel shock had fully flowed through. Put it in dollars, the average cost of building a detached house in this country has gone from around $340,000 to roughly $560,000, a 62% increase. Not the land, just the build. And the pressure is still on. Nigel Satterley, who runs one of Australia's largest residential land developers, warned this year that the fuel crisis alone could add up to $50,000 to the cost of a new house. PVC piping up 37%, cement up 25%, quarry products up 50%, add anti-dumping duties on imported steel of up to 82%, fuel surcharges on every cubic metre of concrete, and a skilled trade shortage that Infrastructure Australia doesn't expect to resolve until 2028. Here's why that matters for the house you already own, or the one you're about to buy. Every existing dwelling in this country is priced against its replacement. When it costs $550,000 plus land just to build a new one on the edge of town, the established 3-bedroom house 5, 10, 15 kilometers closer doesn't get cheaper. It gets repriced upwards against that floor. And Presley adds the kicker. On industry estimates, roughly 40% of a new property's purchase price is government taxes and charges. 3 levels of government are baked into every slab. Now, the demand side. Net overseas migration was 306,000 people in the last financial year on ABS figures. As of January this year, there were 2.98 million temporary visa holders in the country, the highest number ever recorded. Treasury keeps forecasting migration will fall to 260,000, and the forecasts keep being wrong. Actual arrivals have offshot official projections year after year. And here's the part almost nobody says out loud. More than 4 in 5 new migrants rent before they buy. Every one of these needs a roof on day one. They don't check the tax code at the airport. So who supplies the roofs? Presley's research lands the number that should be in the front page of every paper in the country. 41 years ago, the combined contribution of every state, territory, and federal government to Australia's rental pool, whether Housing Commission or affordable housing, was 340,000 dwellings. Today, after 12.3 million additional people, it is still 340,000 dwellings. The other 3 million plus rental properties in this country are supplied by private, everyday Australian investors, mum and dad landlords with 1 or 2 properties. And the official response in the 2026 budget is to tax that exact group harder while building approvals stall, while the 1.2 million homes target drifts further out of reach every quarter. Cotality reports on it. Shrinking supplier incentives, compounding demand. You don't need a research department to finish that equation. But it helps to have one confirming it suburb by suburb. So let's assemble the machine, because this is the long-term mindset that separates investors from spectators. 1. The land component of a well-located detached house is finite. They're not making more of it where the jobs and infrastructure already are. 2. The building that sits on that land costs more to replace every single year. Let that sink in. 62% more than it did 6 years ago, with every input still under pressure. 3. The queue of people who need that dwelling grows by hundreds of thousands a year, while the public sector's contribution to housing them has been frozen for decades. Construction costs rising, migration compounding, government supply flat. Whatever capital city or regional market you look at, whatever style of detached house you buy, provided it passes the fundamentals, the long-term direction of that equation is heading in one direction, and that is up. Now, the discipline matters, and this is where most people get it wrong. Property always goes up is not a strategy. Darwin apartment owners just lost 15% over a decade believing it. The 41-year record rewards a specific asset, the detached house in a market with vacancy under 1.5% with a constrained approvals pipeline, bought with a horizon measured in market cycles, not news cycles. That asset rode through 16% interest rates in the 80s, a recession, the GFC, a pandemic, and 4 decades of tax tinkering, and went from $75,000 to $1.2 million. Now, I want to show you something. This is a newspaper clipping from 1984, surfaced in Presley's article. A housing shortage. Politicians promising to fix affordability. Warnings about rent. Read it carefully because apart from the typeface, it could have been published this morning. That headline is 42 years old, which means some Australians have now spent their entire adult lives waiting for a government, any government, either side, to make property cheaper before they act. They were waiting in 1984. They were waiting in 1985 when negative gearing was abolished and prices rose 27% anyway. And if they're still waiting today, the cost of that patience is the difference between $75,000 and $1.2 million. Meanwhile, the people who understood the mechanics, replacement costs, population supply, they didn't wait for permission. While the headlines recycle, the asset compounded. And here's the uncomfortable question to sit with after this video ends. In 10 years, when construction costs have done another decade of work and another 2 million plus people have arrived needing a roof in this beautiful country, which side of that history do you want to have been on? So here's where this lands. If this video was uncomfortable, good. It should be. The market doesn't care about anyone's political opinion, including mine. It prices concrete, land, and people. Our job at PropSpotter is to find the specific suburbs and the specific properties where those three forces are heavily tilted in your favor. Research it, source it off our proprietary alerts at a fixed fee, and then coach you through everything that comes after settlement. But we don't work with everyone, and frankly, we can't. The client book is kept deliberately small so the research stays sharp. We don't take inquiries, we take applications. If you're serious about your next investment, whether that's this quarter or you're building towards it over the next couple of years, the application link is below. Tell us where you're at. If we're the right fit, you'll hear from us. If we're not, we'll tell you that too. Subscribe if this changed how you see the market. The next video goes deeper on exactly where these forces are strongest right now. I'll see you there.